Good morning, Oracles. So looking at Tesla's 10K, they disclosed that their Capex spending for the next 3 years is going to be between $5 and $7 billion. So to put that into perspective, they spent just over $6 billion in 2021. So what does that mean for the next 3 years? Well, if they keep their spending at $6 billion between that $5 to $7 billion range, but their revenues keep on going up by 50% every year. And when you can keep your capital expenditures even like that for 3 years in a row, that just shows how efficient and lean the company is with their money and how they operate their business. This is something we talked about on yesterday's video, Fail Forward. They have a culture of running a lean business, and this is proving it. I mean, they're opening up 2 factories, with $6 billion of expenditures. And over the next 3 years, this could include another factory or 2 and expansions on their current factories. And this just shows how great they are at investing in their own business, because they are able to invest this same amount of money for 3 years, but get a much larger return on that investment every single year going forward. So it's just incredible how they operate like that to be able to build bigger and bigger margins and cash flow at the bottom line. And in spending this $5 to $7 billion in Capex for either new factories or expansions, that means that they're going to be growing their employee population as well. They disclosed in their 10K that they were up to nearly 100,000 employees. So, that is putting them close to GM and Ford. GM's around 155,000 and Ford's a little bit north of 100,000. So, the fact that Tesla is growing at the rate that they're growing, and they're going to be adding so many more jobs, they will take over the lead in employees for a company in the automotive industry here in the US as well. And so just one more piece of the leader puzzle that Tesla is taking. And other good fundamental signs of this movement going forward for the EV revolution is the fact that Nissan and Daimler both announced that they're going to be halting most of the development for their ICE vehicles going forward. This just shows, we saw in the charts that the EV adoption is growing higher than expected, faster than expected, and now legacy automakers are starting to see that this is happening, and they need to transition faster. And we all know what happens when you rush things. When you rush things, they tend to not go so well, and the quality isn't as good. So, I do wish them the best. I like the fact that we are going this route. I like the fact that we're going to a more green world. And so I applaud all of the efforts from all of the legacy automotive makers, but it's just something to keep in the back of my mind of these people are pulling the trigger last minute, sort of in panic mode. Let's make sure that we have good products coming out of this as well. Because a very important piece of EVs taking over ICE vehicles altogether is having a good experience with them. So if we have automotive makers who are rushing into things and creating a product that isn't as good, it may put a sour taste in people's mouths. So, we know Tesla, it's not going to have 100% of the market. That's impossible. So all the other automotive makers who are creating vehicles need to produce decent quality vehicles for people to ride in. Obviously, over time, there's going to hit a point where EVs will be a better vehicle and less expensive than ICE, so it just wouldn't even make any good, smart sense to purchase an ICE vehicle. So eventually we'll get to that point, but if we can start that ball rolling earlier, that will be great for EV adoption faster. And of course, these are all things that we look at fundamentally as we're looking at the stock going forward, because right now, in the macro environment that we're in, stock prices are very much all over the place. Although with Tesla, while it has been wavering back and forth, we do start to look like we're in a consolidation period right around that $900 mark. So I've been monitoring this, taking a look at the charts, and we're starting to form a little bit of a wedge. Don't know what's going to happen with it, but we are anticipating, some positive catalyst news coming between Austin opening, Berlin opening, potential S&P credit rate upgrade. So, we have a lot of positive catalysts coming. I think a lot of people are anticipating these catalysts. So I don't know how much of it is built into the price or not. Only time will tell on that when the news does drop. But it does look like we're kind of trading more evenly sideways at the moment. Now, we do have CPI data coming out on Thursday. That can throw everything all off entirely. So that's why, short-term price predictions in the stock market, it's just not going to happen. It's literally a coin flip as to what's going to happen with the pricing. I just know long-term it is going to do well. I do see this year being a roller coaster ride, but a roller coaster ride that does net gain at the end of the year. How much that net gain will be, I do not know. I still hold my price target of 1920 on Tesla for right now until I hear what's going on with the Fed in March. And if their news changes the market or my feelings for the macro environment, that may in turn change my price target. But that doesn't change my thoughts on the company itself. It is strictly a macro environment, valuation compression type situation that may bring the price target down. Let me know your thoughts below. What do you think that Tesla is going to be spending their $5 to $7 billion on every single year for the next 3 years? Do you think it's new factories? Do you think it's expansions? Let me know your thoughts. Thank you all so much for watching. I appreciate all of your support and feedback. If you have not subscribed, please do so down below. Sign yourself up for notifications. I am over on Twitter at OracleTim1. I share all of the latest Tesla news, pertinent stock market information, and all of my daily trades. Thank you so much. Have a great one.